Hi, I'm Ramiro. Thank you for joining me on my channel today. Our homes represent one of the most valuable and expensive assets that we possess, and how we pay for them can have a really big impact on our finances. So, how should we pay for them? Let's talk about it. All right, so when it comes to purchasing our homes, we have a variety of ways to do that. We can pay cash, we can finance it, and that's what I'm going to talk about today. I'm going to give you various options to consider. But before I do that, why don't we have a little history lesson on mortgages? Mortgages in the United States were created to address the need for affordable home ownership and stimulate economic growth. Before the modern mortgage system, land ownership was largely restricted to the wealthy, as acquiring property often required significant capital. This limited home ownership and created a barrier for the majority of Americans. In the early 20th century, the U.S. economy faced a challenge. Many Americans aspired to own homes, but lacked the financial resources to make such a significant investment up front. The traditional system of home buying, which required full payment at purchase, was impractical for most families. This gap created a need for a financial mechanism that would allow people to purchase homes with a manageable financial commitment over time. The concept of a mortgage, a loan specifically for purchasing property, began to evolve in response to these needs. In the 1930s, during the Great Depression, the U.S. housing market was in crisis, with widespread foreclosures and a sharp decline in property values. In response, the federal government introduced several key reforms to make homeownership more accessible and stabilize the housing market. The Home Owners Loan Corporation, or HOLC, was created in 1933 to refinance struggling mortgages and prevent foreclosures. More importantly, the Federal Housing Administration, the FHA, which was established in 1934, provided insurance for mortgages, which reduced the risk for lenders and allowed them to offer loans with lower down payments and longer terms. These innovations were crucial in making homeownership attainable for a broader segment of the population. After World War II, government initiatives like the GI Bill further supported home ownership by providing veterans with more favorable loan terms. These measures collectively laid the foundation for the modern mortgage system, aiming to make homeownership accessible, stabilize the housing market, and stimulate economic growth. So when it comes to mortgages and how we pay for our house, there's some misconceptions out there, and then there's some truths out there. And so what I want to do is start off asking you to consider some questions, and then in your mind, answer whether you think they're true or false. And at the end of my video, we're going to revisit these questions again. And don't worry, it's not going to be graded, but just keep your answers in mind when we review this at the end. So the first question is true or false? A large down payment will save you money over time than a small down payment. A 15-year mortgage will save more money over time than a 30-year mortgage. Making extra principal payments saves you money. The interest rate is the main factor in determining the cost of a mortgage. And finally, you are more secure having your house paid off than having it financed 100%. So think about those questions and think about the answers that you gave, true or false, and then we'll revisit them at the end. But let's continue to keep talking about mortgages and how you pay for your house. It can be pretty confusing which might be the best because there's so many options that we have. I mean, you can do 15-year mortgages, 30-year mortgages, adjustable rate mortgages, interest only, balloons. I mean, there's no shortage of payment options that are available to us. But please keep in mind and think about this, that like I said before, your house is probably the largest personal investment that you will make, and how you decide to pay for it can create some unnecessary wealth transfers. And what do I mean by wealth transfers? Well, that's money that's leaving your financial model without you knowing about it or unnecessarily leaving. And the way we finance our things can add to those wealth transfers. Let's keep going. So, like I was saying, wealth transfers can occur no matter how you decide to pay for your house. So, if you do decide to finance it, you're going to be transferring interest to the lending institution just for the privilege of using their money. All right, that's the finance charge. Now, if you decide to pay cash, if you have that amount of cash sitting around and you just buy your house outright, basically self-financing, then you do save on the finance charge. But think about this, then you lose the interest too, because that money will no longer be earning any kind of rate of return for you. In other words, if you spent that money on your house, you can't put it in, you can't invest it in the market or put it in a bank account that's earning interest. So understanding where these wealth transfers can occur in your mortgage can prevent some unnecessary losses. So the first question to explore is, why even have a mortgage? You'll read about it and hear about it on different areas that pay off your mortgage, or you shouldn't even have a mortgage. There's no reason to have a mortgage. But I want you to consider that there's three big reasons why you should consider having a mortgage. The first one is, obviously, if you don't have enough money to pay for your cash out of pocket. Secondly, is the tax deduction. The mortgage interest deduction is still one of the largest tax deductions that we're still allowed when we file taxes. And the third one is the potential beneficial spread. In other words, the difference between the cost to borrow money and what you could earn on that money if you invested it in the market. That's called a beneficial spread. So another thing to consider when you're thinking about mortgages is inflation, because inflation is a major consideration in paying down a mortgage. Consider the following. The average monthly payment today in the United States is $2,167. And that's per the Mortgage Bankers Association. But anyway, let's use an inflation rate of 3%. I know that recently it's been higher than that, but over the last 30 years, I think that's pretty accurate. So let's just do a simple calculation here. In today's dollars, what would money feel like in the future? In other words, as we inflate it over time. So let's do this. So in 15 years, what would $2,167 really feel like in today's dollars? Well, in today's dollars, $2,167 15 years from now is really only going to feel like $1,390. Let's continue this. In 20 years, $2,167 is only going to feel like $1,199. And 30 years from now, $2,167 is only going to feel like $892.78. And so it reminds me of when I was, visiting with my parents, and I was just amazed at how low their mortgage payment was. I was like, wow, I'm buying a house now. Mine's so much more than yours. Well, that's because they bought their home many, many years before I did. So consider that. As time goes on, it becomes a lot easier to make our mortgage payment due to inflation. So also, consider this, the bank is watching your equity grow just as you are. But unfortunately, you're not only paying the bank its interest rate or the finance charge, but you're also giving it your principal amount. So you're making principal and interest payments to them. And so you're giving away the opportunity to invest that money and benefit from its future growth. And that's where we get into what's called opportunity cost. In other words, things to consider. So, do you earn any interest on the down payment of your house? Also, is the down payment that you make, is that money accessible to you? Well, the answer is no to both of those. And what would your down payment be worth today had you been able to invest it? That specifically is what I mean by the opportunity cost. So let's look at an example of that. Let's say you had a down payment of $20,000 And let's consider an investment rate of return of 8%. Now, one thing you need to consider is this disclosure. I'm not going to read it, but I'll post it there. Okay. This is just hypothetical rates of return. Now, I can tell you this, that over the last 30 years, the average rate of return that the Standard and Poor 500 index provided was 9.6%. So I'm wanting to be a lot more conservative than that because people might say, well, what if we can't get that? So I think 8% is fair. And let's say you purchased that house 15 years ago. So what is the opportunity cost of that $20,000 over the last 15 years? Well, your opportunity cost to date is $46,138. So what does that mean? Well, if your down payment of $20,000 had been invested in the market and you were able to get an 8% return for that 15 years, you would have earned 46,138 over your original down payment of 20,000. This is what I mean by the opportunity cost of your down payment. Let's continue. Is your house a good place to park your money? Well, if the current value of your house is 420,000, which by the way is the median house value today in the United States, and let's say you had purchased it for 175,000, which by the way takes into consideration the average appreciation over the last 15 years. And let's say, but in that 15 years, you sunk in another $25,000 of improvements. You added a porch or you added a room or you did some things to your house where that you improved it. So over 15 years, what is the rate of return of your home? Well, the equivalent compound interest rate of return is 5.07%. So you have a gain of $220,000 over 15 years. That's pretty good. But this is equivalent to an annual compound interest return of 5.07% over that same period. So think about that. How does that return compare to inflation? And how does it compare to your other investment returns? Something else to consider, and this is when we get into appreciation versus equity in the house. So what does equity in the house mean? Well, equity means the difference between what your house is worth, the market value of your house, and what you still owe on that house. So let's take this consideration. Let's say your current market value of your home is 420,000 and you have an outstanding loan balance of $100,000. So the inflation, let's go ahead and take a look at inflation over 3%, like I mentioned before. Let's calculate that. So the equity in your house right now would be about $320,000. But think about that. You've got $320,000 of equity. In 30 years, the buying power of your equity really is only going to be $131,000 in today's dollars. By contrast, in 30 years, the purchasing power of the market value of your house will be 420. Okay. Now, one thing to keep in mind is this, and this is, like I said, where equity and market value come in and kind of confuses people. Let's say you have a house and it's worth $420,000 and you have it completely paid off. And I own the house right next door to you and it's exactly the same house, exactly the same floor plan. Everything is exact and it's worth $420,000. But I owe $420,000 on it. That's my outstanding loan. So does the amount that I owe on that house have any impact on the market value of my house? No. The market value of our homes is completely independent of whatever we owe on it. So equity has no impact on how much our house is worth. Our house, the market value of our house is dependent on market conditions. So keep that in mind. The greater amount of equity you have does not increase the market value of your home. So why choose a 15-year mortgage over a 30-year mortgage? And when you go in, you're going to notice when you're talking to a mortgage officer, a lot of times they're going to give you that choice. And the reason we're comparing 15-year to 30 years because those are the most popular. But there's a good reason why a lot of people think having a 15-year mortgage is probably better than a a 30-year mortgage. So the number one reason people choose a 15-year mortgage is because the interest they think they will save. The perception is that a shorter loan duration reduces the cost of the loan. But if you kind of follow that logic, then the best alternative is just paying cash for the house outright if you had that ability. So the other thing that people say is that, once I get my house paid for, then man, I'm really going to be able to save for my future. So I want to pay off that mortgage quickly in 15 years and then use that entire amount, that entire payment amount to start investing. So let's compare this. Let's say the loan amount is $175,000. Okay. And actually, that's kind of understated. Let's go ahead and bump it up to today's market. So average value of the house of the homes is 420. If we make a $20,000 deposit on that, that means our loan balance is going to be 400,000. Okay. The loan rate, you can go to bankrate.com or other sources, and you're going to see varying loan rates right now, but I think 6% is a pretty good average. So if we're considering a 15-year mortgage versus a 30-year mortgage, and we're financing $400,000, then your monthly payment for a 15-year mortgage is going to be $33.75. If you extend it out to 30 years, then your monthly payment is going to be $23.98. So the monthly difference is about $977. So let's make a calculation. Now, one thing to consider, if our loan rate and the rate of return we could get if we invested it in the market was the same, 6%, then really there would be no advantage or disadvantage to financing your home either 15 years or 30 years, because you see at the end of the 30 years, both of these consumers, consumer A, which is 15-year mortgage, and consumer B, which is 30 years, their side account would have grown to the exact same amount of money, $981,000. But what if we earned what really the markets have earned? And I'm not going to put in the 9.6. I'm going to go ahead and dial it down to 8%. So what would happen then? Well, kind of a different story. At the end of 30 years, consumer B, which financed it for 30 years, they would have $1.4 million in their account, as opposed to $1.1 million invested at 8% after 15 years. So once again, with this example, consumer A for 15 years pays off their amount. They make their $33.75 a month payments for 15 years. And then beginning in year of 16, they start investing that entire amount for the remaining 15 years. So at the end of 30 years, they have 1.1 million in their investment account. Consumer B started investing that difference, $977 on day one of their mortgage. So 30 years later, their side account has grown to 1.4 million. Let's continue. So let's compare two mortgages again. Okay, once again, borrowing $400,000. Mortgage one is a 30-year conventional loan. Your payment is going to be $23.98. Mortgage two is a conventional 15-year loan. Now, one of the things people say is, well, hey, if I get a 15-year loan, my rate is less. And that is true. If the banker, usually when you go in there, the mortgage banker is going to give you an incentive for paying off that loan in 15 years. And usually it's a discount. Usually it's anywhere from 0.5% to 0.75%. For my example, let's say they give you a full point off, so 5%. Okay, so that means your loan payment is going to be $31.63. And let me ask you this. Why do you think the mortgage bankers or the bank is giving you that discount on that 15-year loan? Do you think they're doing it out of the kindness of their heart? I was in banking for a long time, and I can tell you this from personal experience. The answer is no. They're not doing it because they're doing you any favors or, out of the kindness of their heart. No, the reason they give you a discount for a 15-year term is because they want their money back sooner, because they'd rather not extend their money out for 30 years if they can get it repaid to them in 15 years. They want that money back sooner than later. So let's go ahead and continue on this. A couple of questions to think of. What rate of return is required in the side fund to pay off the 30-year mortgage in 15 years? What do you think it is? The required rate of return is 6.64% net after tax. In other words, after 15 years, a side fund return of 6.64 net after tax will provide you with $284,000 in the side fund. The balance of the 30-year mortgage after 15 years is going to be about the same, $284,000. Now, this assumes that you're in the tax bracket of 22%. So that's the amount of return that you would need in order to be able to pay off your mortgage in 15 years. Now let's continue on that. Assuming a side fund return of 8%, when will the side fund balance be adequate to pay off the balance of mortgage one? What do you think? 14 years and 4 months. If the side fund returns 8% net after tax, it will actually be larger than mortgage one in 14 years and 4 months, or 172 months. At that time, the balance of the side fund will be 293,000 and some change, and the balance of mortgage one will be 291,000 and some change. Once again, this results assume a tax bracket of 22%. So consider that. If you wanted to, after 14 years and 4 months, you could pay off your mortgage if you wanted to, because you're going to have that amount of money in your side account. But then you might want to ask yourself, well, why would I want to do that? Would I want to just keep that liquidity available to me, or lock it up in my home where that I really don't have access to that money? Let's continue. The other big advantage, like I said, was the tax savings. Our mortgage interest deduction is still one of the largest items that are available to us in our taxes. And if we compare the tax savings between the two, in 15 years, mortgage two, which is a 15-year, we'd save $37,000 in taxes. After 15 years, the 30-year mortgage, we'd save $69,000 in taxes. And why is that? Well, as you may know, when we do mortgage payments and we have a mortgage, most of our money during the early payments or repayment is going towards interest. Most of our monthly payment goes towards interest at the beginning of the note. Over time, it flips, and then most of it starts going to principal. So since you're paying most of that interest up front, you get to have a bigger mortgage deduction. So when we advance this out to 30 years, there's a pretty big difference between the tax savings. So now let's go ahead and have a wrap up and revisit that quiz that I gave you at the very beginning of my lesson today. So true or false? A large down payment will save you more money over time than a small down payment. Well, I think we proved that that's not necessarily the case. Second question, a 15-year mortgage will save you more money over time than a 30-year mortgage. Well, I think we pretty much shot that theory or understanding out of the park. That is false. Making extra principal payments saves you money. Once again, we proved that that's not necessarily the case. We talk about lost opportunity cost. The interest rate is the main factor in determining the cost of a mortgage. Well, we realized that it's one of them, but it's not the main factor in determining the cost of a mortgage. And finally, you are more secure having your house paid off than financed 100%. Well, I believe that it's false. And some people give me some pushback on this, and they're like, no, I'd much rather have my house paid off, because if something happens. So, well, that's true. Well, let's talk about that. What could happen? So there are many reasons not to have a mortgage, but there are 3 emotional reasons to consider one. First off, what happens if you become disabled? Because of your injury or your illness, you're not able to work anymore. So you have no income coming in. Or what about another option or possibility out there? You lose your job. either because you were fired or because there's a reduction in force or your company gets sold or it closes down, whatever. There's a number of reasons why we could lose our job. But in either one of those cases, you don't have any income anymore, but you still have living expenses. You still have to buy groceries. You still have to pay your electricity bill. You've got to pay your car payments, insurance payments, all those things. They don't go away, but you don't have money coming in. So what's your option? Well, people say, well, I can go get a loan. I can borrow against my house. Yeah, you could. You could get a home equity loan or home equity line of credit. That is true. But there's only one problem with that. And that is when you apply for a loan at a bank, you have to be able to prove that you can pay that loan back. And if you don't have any income, you can't do that. And so the banker is going to decline your loan. So borrowing against that and trying to pull out all that equity out of that house is just not going to happen. So the other thing people say is, well, then I could just pretty much sell my house. Okay, you could sell your house, get $420,000. But then what? You still got to live somewhere. People rather live inside than outside. So what are you going to do? You're either going to be renting an apartment or a condo or something, or you buy a much smaller house because you're going to need that cash to help sustain you for who knows how long. Either way, your standard of living is going to go way down. So that's really not a practical option either. And then finally, there's just so much uncertainty in the world. We don't know what's going to happen. We don't know how, interest rates are going to go. We don't know how inflation is going to go. We don't know a lot of things. So having your house paid off doesn't make any of those things any easier. So just keep that in mind when you're considering having a house paid off or not. Other thing to keep in mind, and that is our homes are one of the most illiquid assets that we own. It's just so hard to pull value out of them. It's a great place for us to live, and it provides a lot of things to us, a lot of benefits, like I said, but liquidity is definitely not one of them. All right, so what did you think of my lesson today? Were you surprised by any of the information on it? Was it eye-opening? And is it going to maybe change your attitude towards mortgages? Well, regardless, I hope at least it was helpful to you and informative. And as always, if you have further questions and you want to reach out, I'd enjoy visiting with you. And remember to subscribe to my channel, like this video, and turn notifications on. I hope you have a wonderful afternoon. Goodbye.